Hi Jiun Yeh, thank you very much for joining us. 2022 was a pretty horrible year for investors, but looking back, what was the world like pre-COVID?
Well, pre-COVID, we were in a regime where lower for longer, lower inflation, lower interest rate, with very high liquidity, because of all the quantitative easing being rolled out by the central bank. And especially during the pandemic period, there were even more quantitative easing by the central banks in many parts of the world.
So, how has the world changed since then?
Well, I suppose we need to look at the world quite differently now, where there is no more free money, with all the quantitative tightenings, being introduced by the central banks. And of course, we have the Russian-Ukraine war, there is supply chains disruptions, and also, US-China tensions that cause a lot of disruption to the global trade. And in addition to that, we also have labor shortages, in some of the service industries, especially when countries start to reopen up, over the last couple of months. And not to mention the climate crisis that we have experienced over the last 18 months.
Given what you've just said, what should people be looking out for in the post-COVID era?
Well, I think in the years ahead, we are likely to enter into a regime, higher for longer. First, you have higher inflation. Second, higher interest rate. And third, lower liquidity. And fourth, slower growth. In fact, in some countries, they're probably going to recession and even stagflation in some part of the world.
Jiun Yeh, if these themes play out, what are the investment opportunities that people should be looking out for?
Well, I suppose some of the important factors that investors need to take into consideration will be liquidity and defensiveness. As we are in a lower liquidity environment, you want to select assets that give you very good liquidity, like for example, G7 govies, treasury bills, very short duration, IG credits, even gold that give you that diversification. And in addition to that, stability and resilience will be another important factors that we need to consider seriously. Sector that give you the resilience, like green sector that give you the environmental resilience, certain industrial sector, even including defense-related industries, infrastructure and risk asset that give you the stability of income, and last but not least, value sector or value stocks one should consider.
So, what are the sectors that people should avoid?
Some of the negative investment implications in this environment that we are having, we need to probably look into some of the zero policies. The zero interest rate policies is over, so investors should avoid illiquid and hard to value assets, like your loans, your private equity, your venture cap, even your high yield credits. And one quick example is all the crypto related bankruptcy that we are going through now. The other zero policy will be the zero COVID policies that some countries are still implementing, which will have a negative impact on economic growth that will lead to earnings downgrade, negative impact on certain consumer sector. And last but not least, the zero carbon or net zero targeting policies by a lot of countries and companies. There will be a cost in achieving that goal.
You mentioned zero COVID policies. What is your outlook for China in 2023?
Interestingly, I think if you look at some of the policies lately, so there seems to be some kind of relaxation on the COVID zero policies. And I think that is very important. In fact, we have already seen some strong rebound in the China-related assets. And we think this is probably the beginning of relaxation and more orderly kind of managing the COVID situation rather than just lockdown and curbing all the economic activity. So at least in the next 3 to 6 months, generally positive on China-related kind of markets.
So Jiun Yeh, one final question. What is it that you think investors should take away from today's discussion?
Well, my concluding message to our investor is high liquidity and low volatility. Beyond your conventional asset allocations, I think one should carve out some part of your fixed income into very short duration, very liquid asset like your treasury bills, your govies. And for the equity allocation, there should be certain sector that give you the environmental and geopolitical resilience, like your green sector and some of the industrial sector, and some income-driven, kind of assets like infrastructure assets.
Jiun Yeh, thank you very much for joining us today.
You're most welcome. Thank you.